Welcome to Rule 4 of the SRA's Accounting Rules. This is the rule covering how client money should be kept separate from money belonging to the authorized body, in this case, the solicitor's firm. So Rule 4.1 states you keep money separate from money belonging to the authorized body. So on the one side, the client money must be kept in a separate bank account and completely away from the firm's business account, which are the funds where the firm uses day to day and where the firm has control over and ownership over. So when the client account is reviewed, and that will happen annually, potentially with your reporting accountants, when it's reviewed, a very important question that will be asked during the review is if there are adequate procedures in place in your law firm for monitoring the moving of client money from the one side to the other. Always a contentious topic. So Rule 4.2 states, so this is what's called the mixed receipts rule. So it states that you ensure that you allocate promptly any funds from mixed payments that you received to the correct client account or business account. So the client could be paying a bill and also transferring money on account for a future bill in one lump sum. So this needs to be promptly split out and put into the correct place. The firm needs to have a policy in place, what the acceptable time period is of transferring this over, and how to identify these types of payments. Rule 4.3, where you are holding client money and some or all of that money will be used to pay your costs, you must give a bill of costs or other written notification of the cost incurred to the client or the paying party. So a notification in this context of the rule could be providing a pro forma invoice to the client, an email, or even a VAT invoice if you are ready to properly invoice for the work done. That is sent to the client. Even a text to the client could be acceptable as a written notification. Then Part B of the rule states that this must be done before you transfer any client money from the client account to make a payment. Any such payments must be for the specific sum identified in the bill of costs or other written notification of the cost incurred and covered by the amount held for that particular client or third party. Just emailing the client saying, hi, we are raising a bill, we're going to transfer money, that is not sufficient. You must be specific on the sum that you are billing, and there must be client money for that specific client available in the client account. You cannot transfer money belonging to another client to cover this client's bill. When you look on your records, there must be a balance with sufficient funds available to transfer for what you are billing. Okay? Cannot transfer somebody else's money for another client. So this one isn't the most complicated rule, but it is a very, very important one and is always scrutinized by the reporting accountants when the annual reporting is doing so. It is key to get this right every time. Next time, we will look at the rule covering withdrawals from the client account. Remember, staying informed is key, and thanks for watching.